2022 has already been a wild year. It's only been 5 months in, and we've seen a wide range of events and incidents that were unexpected. Along with heart-stopping news from the global landscape, we now see China entering, and no, it's not good news. The global economy is going to be hit hard, especially after the US economy is reeling with inflation, and now it looks like China's economy too is going to be hit hard. Stay tuned and watch as we look at how China's crashing economy is going to leave the world in a dark place. We'll also be revealing whether we're going to be struggling like this for years or not. This video is going to be an eye-opener for many, so make sure you watch right until the end. The past year hasn't been good to China, as different events transpired both within the Chinese borders and externally spell doom for the nation. There are several reasons acting as catalysts to the decline, so let's take a look. Real estate decline. The problems with China's crashing economy started with the real estate sector's decline. Real estate has a significant contribution to the Chinese economy, contributing to 29% of China's GDP. Last year, one of the largest property developers globally had a situation that sparked that could only be explained as the beginning of the decline in the Chinese real estate market. For those who don't know, Evergrande, whose liability exceeds $300 billion, failed to make interest payments to international investors. That situation spooked investors who feared contagion across Chinese property and banking sectors as the giant company scampered to find a solution. Evergrande began selling its assets to raise money it owed to various stakeholders, including employees. However, this didn't last long, and Evergrande failed to meet debt repayment and defaulted on 2 bonds. There were several reasons why Evergrande's failure was a concern to China's economy, and even on a global scale. This included the fact that many people bought unbuilt properties from the company, and the defaults meant people could lose their funds in totality. Evergrande also defaulted on internal debts, meaning a lot of companies went into bankruptcy. In 2022, the damage to the real estate arena hasn't been fully recovered. In fact, it keeps worsening. The Chinese real estate market is falling at a rate of 1% per month. This is sending property values crashing. Other real estate agents are suffering defaults due to a wide array of issues. Not least among them is China's issues of ghost cities. You see, about 20% of all urban housing properties in China, accounting for 65 million properties, is vacant. The 20% includes large sections of cities like Tianjucheng, Thamestown, Binhai, and more. These span across hundreds of kilometers, but they also have far more empty buildings than occupied ones. These Chinese ghost cities have really good infrastructure, including roads and public spaces, but are vastly underpopulated. China's 3rd and 4th tier cities are fully built up with the promise of becoming economic hubs, but due to high investment cost or a lack of economic opportunity, they fail to attract inhabitants. With money tied to unlikable, unsellable, and unoccupied buildings, real estate companies are in compromising positions. The challenge that then comes for developers can impact China's financial system significantly. If several real estate developers and firms default like Evergrande did, banks and other lenders may be forced to lend less. That could lead to what is known as a credit crunch when companies struggle to borrow money at affordable rates. In this light, a credit crunch would mean really bad news for the world's 2nd largest economy because companies that can't borrow find it difficult to grow and in some cases are unable to continue operating. With the implementation of the 3 red line policy by the CCP, a set of rules that just put a cap on the amount of money a company can borrow, it was basically guaranteed that companies could not get new debt anymore. This resulted in a lot of companies who were now struggling for cash, suffering bond price sell-offs along with stock price slumps. Given that about 90% of the Chinese population has ties to real estate and home ownership, it makes sense that such a reaction would occur. After all, if the company is struggling, who wants to own their bonds? Bonds meant to guarantee safety. Due to this, China's biggest bond saw $460.4 million of outflows last month alone, as an exodus of money from Chinese assets continued. Couple the declining real estate values, the ineligibility of real estate development companies to secure more money to finish and start projects, along with investors massively pulling money from Chinese markets, and the problems just pile up. When the factor responsible for almost a third of the nation's economy suffers such deep issues, then you can be sure that Chinese economy will feel the punch. The causes of China's problems aren't done, however. You'll really want to hear about the next one. Here's a brief recap. The CCP has its hands in everything, and by everything we mean everything. This is evidenced by the Alibaba sanctioning that led to massive losses that the company still has not recovered from years later. And the Ant IPO that, despite being set to be the world's largest, was blocked by the CCP to inflict a major blow on Jack Ma, This came in the aftermath of Jack Ma giving statements that were regarded as offensive to the government. What the CCP did with Jack Ma, and has since done with hundreds of other companies, only serves the purpose of showing us how intensely difficult it is to prosper in China. Once a company begins to get too large and the owners too powerful, the CCP immediately intervenes to stop them from having too much power. What this does, however, is limit companies from growing to their potential. It also places a cap on the kind of growth one can have without being political, aka supporting the CCP. Because of the influence that the CCP has, it has in recent times been performing market manipulation at its finest. This means that there can be no faith that can be placed in the Chinese stock market behaving organically. The stock market has double-digit swings both positively and negatively frequently, and this does not bode well with anyone with the smallest idea of how safe investing should go. The CCP has even gone so far as to pump billions of dollars to inflate the Chinese stock exchange when they have felt they were leaning towards the losing side in regards to public perception. This manipulation has resulted in money being lost in the millions by unknowing investors. The CCP, aware of this, has come out to say that they will ease strict regulations on both the stock and real estate sector, but this is a take as old as time. We have heard these same words before, and yet the result has been the same. With the CCP in power, China has become uninvestable. Foreign money is hesitant to come in, and given the fact that only 9% of residents in China invest in the stock market, this is going to cause problems of an irreparable nature to Chinese stocks and businesses. Now, what does China's fragile economy and real estate industry collapse mean for the world? The economic slowdown in China and the associated weakness of consumption will have spillover effects on the global economy. The IMF estimates that a 1% decline in China's output lowers global growth by 1/10 of that level. The real estate sector alone absorbs 14% of global value added in metals, 6% in mining, and 5% in chemicals. Equally important to transatlantic economies is that, given the endemic weakness of demand in China, the use of investment, including in manufacturing, leads to overproduction in the goods sector. This policy tool to spur growth continues to dominate in China, even as official policy is to rebalance by improving domestic consumption. Gross capital formation has been 43% of GDP since 2016, including in 2021. China's overproduction is a proximate cause of chronic trade surplus. China had a record merchandise trade surplus of $676 billion in 2021, including a new high $355 billion with the US. The EU also saw a record €207 billion merchandise trade deficit with China, with the German and Italian manufacturing leaders both in deficit position. The UK saw its deficit with China triple in the first half of 2021 to over £40 billion. It is also notable that a sizable proportion of bond and loan defaults are in instruments denominated in dollars and euros. The German economy is especially vulnerable. Its export-driven industrial sector has not yet recovered pre-COVID production levels. Auto production there in 2021 remained nearly half its levels of 2017, and it has lost 2% of global market share in this key industry. Volkswagen sales fell by 37% in 2021 in China, as local competitors clawed back market share and the market moved toward electric vehicles. If the U.S. Congress passes Biden plans to provide enhanced tax credits for purchase of electric vehicles made domestically, it would constitute another blow to the EU auto sector. The impacts on Western economies can only be expected to worsen as the real estate crisis intensifies and China reverts to more debt financing to increase domestic manufacturing and build new technology capabilities to stimulate growth. If China continues to employ draconian lockdowns in major cities to combat COVID, its growth path would be even more at risk. Well, that's all for this video. Hope you enjoyed this one. Thanks for watching.